This is the class what I mean for the ratio analysis for semester 6 students who are appearing for the examination. So we are all locked down strictly. We have to go through the topics very quickly, and the ratio analysis one of the 6 chapters under the financial reporting and financial statement analysis, which is very significantly required for writing of reports and writing of projects. For the BCom students, it is necessary. As many as 6 topics are there: holding company, accounting standard, fund flow statement, cash flow statement, financial statement analysis, and last accounting ratios for financial statement analysis. As you all know that the preparation of projects for BCom honors general students needs thorough knowledge of all accounts, cost accounts, financial accounts, as well as management accountants. So this and the knowledge for economics also required. Knowledge for economics is also required for writing of projects. The students who will be choosing the topics related to economics, that is also very important, and the ratio analysis sometimes is also required for that topic also. But the students who will be choosing the topics financial statement analysis, working capital management, capital formation, capital structuring, for everything, the ratio analysis is very significant. That's why I am taking first this ratio analysis. And what is ratio analysis? Ratio analysis is the process of ascertaining and interpreting numerical relationship between or amongst the figures which are exhibited in the balance sheet or in profit and loss account of any business entity for a certain period. So readily we all know that balance sheets are prepared by the qualified accountants, and after the auditing is done, then report is to be prepared. So from readily available from balance sheets, published data can be collected. But for the financial reporting, that ratio analysis is very important, because some questions are coming every year, and for the semesterary system, the students will be expecting some question on this area. So we have to focus on this ratio analysis. And what is the basis of comparison? Sometimes we take the help of trend analysis, that is time series, correlation, regression, and sometimes inter-firm comparison. What is inter-firm comparison? Involves comparing the ratios of a firm with those of others in the same lines of business or for the industry as a whole. It reflects the firm's performance in relation to its competitors. And sometimes comparison with the other companies, outside companies, on the similar line of business can be done. Classification of ratios, analysis of short-term financial position or test of liquidity is very important. Analysis of long-term financial positions, test of solvency. So long-term financial position, we are going through test of solvency. For the short-term financial position, we are going through test of liquidity. And next, activity ratios, profitability ratios are also important. Ways to interpret accounting ratios: single absolute ratio, group ratio, historical comparison, inter-firm comparison, projected ratios. There are many ways. Test of liquidity. The liquidity ratios are used to test the short-term solvency or liquidity position of the business. It enables to know whether the short-term liabilities can be paid out of short-term assets. And It indicates whether a firm has adequate working capital to carry out routine business activity, and it is a valuable aid to management in checking the efficiency with which working capital being employed. It is also important to shareholders and long-term creditors in determining to some extent the prospects of dividend and interest payments. Liquidity is important aspect for any business that has to be maintained very prudentially. Otherwise, any moment may come when the business operations may be halted or thwarted or be very difficult to manage. Hence, the test of liquidity of any business is very important. That has to be done very strategically to maintain the dignified position to meet the current obligations at a certain moment of time. Now let us discuss about current ratio. Current ratio is very simple to calculate because as we all know, from the balance sheet we get the all summation of current assets. Current assets are sundry debtors, stock, bills receivable, cash in hand, cash at bank. All these assets will give you total of current assets, and current liabilities on the liability side, sundry creditors, bank overdraft, bills payable, outstanding dues for anything, for salary, for wages, electricity bill. So all those are current liabilities. So current assets by current liabilities will give you current ratio, that ideal ratio 2:1. What is the meaning of this? High rate indicates under trading and over capitalization. So low ratio indicates over trading and under capitalization. Both these, under capitalization and over capitalization, is not balanced operation of any business entity. Another thing, absolute liquid ratio. This ratio establishes a relationship between absolute liquid assets to quick liabilities. Absolute liquid assets divided by quick liabilities, that will give you absolute liquid ratio, and this means ideal ratio 1:2, which signifies that the ratio is 1:2 or more than these, concern can be taken as liquid. If the ratio is less than the standard of 1:2, it means the concern is not liquid. Next, quick ratio or acid test ratio. Acid test ratio is also very important. It is a refinement to current ratio and second testing device for working capital, quick assets by quick liabilities. Ideal ratio 1:1. Usually high acid test ratio is an indication that the firm is liquid, has ability to meet its current or liquid liabilities in time, and on the other hand, a low quick ratio represents that the firm's liquidity position is not good. I think so far I have given you this very simple and lucid lecture on this ratio. I think all these things are clear. Not you expected you are not confused. If you are confused, any question, you feel free to ask me through WhatsApp messages. Next, important ratios in test of liquidity. Current ratio, quick ratio, absolute liquid ratio. We have discussed these three. Next, test of solvency. Solvency is very important. For the long-term solvency ratios denote the ability of the organization to repay the loan and interest. When any business entity's assets are more than its liabilities, known as solvent organization. That means the current liabilities, obligations can be made out of its assets. Solvency indicates that position of an enterprise where it is capable of meeting long-term obligations too. So important ratios in test of solvency. I can give you as many as 10 ratios which are very important. Debt equity ratio, debt to equity, proprietary ratio, solvency ratio, fixed assets to net worth ratio, current asset to net worth ratio, current liabilities to net worth ratio, capital gearing ratio, fixed asset ratio, debt servicing ratio, dividend coverage ratio. These are all ratios which are usually necessary when we are analyzing balance sheet or financial statements and we are writing report to the higher authorities or writing any projects for examination point of view. We have to take shelter of all these ratios. What is debt equity ratio? Outsiders fund divided by shareholders fund. Outsiders fund, if the outsiders funds is greater than the shareholders fund, the ratio is greater than 1. That is not always good for the business entity. Ideal ratio is also stated 2:1. It means for every 2 shares there is 1 debt. If the debt is less than 2 times the equity, it means the creditors are relatively less and the financial structure is sound. If the debt is more than 2 times the equity, the state of long-term creditors are more vulnerable, indicate a weak financial structure. And the financial structure is really dependent on the capital formation or capital structure of the company or business entity. How to prepare this capital structure? It needs to study very well trading on equity, capital gearing ratio, all these things are very important. So day by day, when you will be studying all these things in depth, you will be finding interest into the balance sheet analysis or financial statement analysis. Proprietary ratio or net worth ratio, proprietary funds to total assets or capital employed to total liabilities. Ideal 0.5:1. It means higher the ratio, better the long-term solvency financial position of the company. This ratio indicates the extent to which the assets of the company can be lost without affecting the interest of the creditors of the company. So is it clear? Now, solvency ratios. Solvency ratio, total assets by total liabilities. If it is 1:1, then it is all right. No standard ratio is fixed in this regard. It may be compared with similar such organization to evaluate the solvency position. Higher the solvency ratio, the stronger is the financial position and vice versa. Fixed assets to net worth. Net fixed assets to net worth. It is important. Ideal ratio is 0.75:1. A higher ratio, say 100%, means that there are no outside liabilities and all the funds employed are those of shareholders. In such a case, the return to shareholders would be lower rate of dividend, and this is also a sign of overcapitalization. That means you have to assess through trading on equity. Debt composition and the owner's fund composition in the capital structure has to be evaluated for the better performance of the company or the entity, any entity under the obligation of company's concept. Current assets to net worth ratio, it is obtained by dividing the value of current asset by the amount of proprietor's fund. Current assets divided by proprietor's fund, definitely current assets to net worth ratio, it is given. A higher proportion of current assets to proprietor's fund as compared with the proportion of fixed assets to proprietor's funds is advocated. Current assets to net worth, current liabilities to net worth is also important. Current liabilities to net worth. That means ideal ratio 1:3. So from this ideal ratio, it is easily understood that what should be the business, and if this is not within this ideal ratio, we have to write the comment. This ratio indicates the relative contribution of short-term creditors and owners to the capital of an enterprise. If the ratio is high, it means it is difficult to obtain long-term funds by the business. then business will be facing some problems in borrowing funds. Capital gearing ratio is one of the very, very important for leveraging the benefit on trading on equity and earning per share and dividend payout ratio. So the capital gearing ratio means fixed interest bearing securities plus fixed dividend bearing shares. It expresses the relationship between equity capital and fixed interest bearing securities and fixed dividend bearing shares. So debentures, long-term loans, long-term fixed deposits, components of fixed interest bearing securities, debentures, long-term loans, long-term fixed deposits. Components of equity shareholders fund, equity share capital, accumulated reserves, profits, and less losses and fictitious assets. So capital gearing ratio, fixed interest bearing securities, that is FIBS plus FDB, fixed dividend bearing, both this sum divided by equity shareholders fund. Total equity shareholders fund segregated into two parts: fixed interest bearing securities and fixed dividend bearing securities. So when we have got this ratio, we can assess how much funds is obligatory to pay in the fixed interest fund. And after paying out this interest, we can pay dividend to our shareholders who are the real owners of the company. And interpretation of capital gearing ratio: when fixed interest bearing securities and fixed dividend bearing shares are higher than equity shareholders funds, the company is said to be highly geared. When the fixed interest bearing securities and fixed dividend bearing shares equal to equity shares capital, it is said to be evenly geared. And when the fixed interest bearing securities and fixed dividend bearing shares are lower than equity shares capital, it is said to be low geared. So how much gearing format we have received? Highly geared company, low geared company, and balanced geared company. If capital gearing is high, further raising of long-term loans may be difficult. An issue of equity shares may be attractive and vice versa. I think this part is also clear to you. Fixed assets ratio, fixed asset divided by capital employed. Total capital employed and fixed asset, there is a relationship and it is ideal 0.67:1. This ratio enables to know how fixed assets are financed by use of short-term funds or by long-term funds. This ratio should not be more than 1. Fixed charges covered or debt service ratio. Debt service ratio, net profit before deduction of interest and income tax. That means profit PBDIT divided by fixed interest charges. Fixed interest charges. Ideal ratio 6 or 7 times. If the ratio is high, it means there is higher margin of safety for the long-term lenders, and as such it is not difficult for the business to obtain further long-term funds and vice versa. This ratio indicates the ability of the business to maintain the dividend on shares in future. If this ratio is higher, it indicates that there is sufficient amount of retained profit. And retained profit means plowing back of profit. Okay, that is actually, it is into the net worth of the business. That undistributed profit is being plowed back. So there is no interest charge or any cost on this. Even if there is slight decrease in profit in the future, it will not affect payment of dividend in future. Activity ratio. Activity ratios indicate the performance of an organization, how the organization is performing. That can be determined by activity ratio. This indicates the effective utilization of the various assets of the organization. Most of the ratio failing under this category is based on turnover, and hence these ratios are called as turnover ratios. Important ratios in activity ratio. What are those important ratios? Stock turnover ratio, debtors turnover ratio, creditors turnover ratio, working capital turnover ratio, fixed asset turnover ratio, current asset turnover ratio, total asset turnover ratio, sales to net worth ratio. Most of the ratio are related to turnover. So efficiency relates to turnover is very important. Stock turnover ratio, inventory turnover ratio, cost of goods sold divided by average stock. And cost of goods sold, sales, gross profit, sales minus gross profit, that is equal to opening stock plus purchase minus closing stock. And average stock, opening stock plus closing stock divided by 2. Interpretation of stock turnover ratio. Ideal ratio is 8 times. A low inventory turnover may reflect dull business. Overinvestment in inventory, accumulation of stock, and excessive qualities of certain inventory items in relation to immediate requirements. And high ratio may not be accompanied by a relatively high net income, as profit may be sacrificed in obtaining a large sales volume, unless accompanied by a larger total gross profit. It may indicate under investment in inventories, but generally a higher stock turnover ratio means that the concern is efficient and hence it sells its goods quickly. So stock turnover ratio is related to also sales and how sales is efficiently done, and it relates to closing stock. So volume of closing stock will be higher when sales is not performed efficiently, and it has to be assessed through these, and remarks should be given. Debtors turnover ratio, debtors net credit sales divided by average debtors. Average debtor means opening balance and closing balance divided by 2. Debtors turnover ratio is also very significant because working capital locked in the hands of traders. An average collection period represents the average number of days for which a firm has to wait before its receivables and converted into cash. When you have to study the working capital management in the financial management or anywhere, any part in the course, then you will see there is a working capital cycle, relates to period, that the block period is there. One of the most important aspect of this block period is sales related to debtors, that is credit sales. So number of working days in a year divided by debtor turnover ratio, that will give you average collection period. Interpretation of debtor turnover ratio, ideal ratio is 10 to 12 times. Debt collection period of 30 to 36 days is considered ideal. A high debtor turnover ratio, low collection period is indicative of sound management policy. So debtors management is also very important so far as the working capital management is concerned. When you will be writing project, be very careful about these ratios, and the debtors management is also should be given due care. The amount of trade debtors at the end of period should not exceed a reasonable proportion of net sales. Larger the trade debtors, greater the expense of collection. And creditors turnover ratio, similarly, it is also important because it is liability part. Net credit purchase divided by average creditors. And what is average creditors? Opening balance of creditors plus closing balance of creditors divided by 2. Average payment period is also important. Number of working days divided by creditors turnover ratio. So I conclude here that to tell you 2 or 3 lines regarding this ratio. There are so many things I can cover, but within a very short period of time, and we are all locked down, so we have to grasp the course very quickly to appear at the exam efficiently. So you study. If you find any problem, feel free to ask me through WhatsApp, Messenger, whatever you do like. So first go through this, you study this, and when you start writing project, suppose debtors management of a company, you collect 3, 4, 5 years published data, published balance sheet, and assimilate debtors, and you calculate debtors turnover ratio, and debtors management will be guided with that project report. So I'll be guiding later on regarding this project writing. If you choose the working capital, then you can choose working capital for your project. If you choose the impact of solvency of a particular company, you can compare that over for 5, 3, 5 or 10 years, whatever may be data available through published balance sheet. You can collect and start writing project and study for financial statement analysis. So regarding ratio, if you find any problem, any question, feel free to ask me. So next class, I hope I will take on holding company. Okay, take care of. Thank you. Be healthy and go steadily at home.